Welcome back to our webinar number 3. I am so sorry that I couldn't join the webinar as planned due to the issues that we are experiencing. But with this webinar, there isn't much that we are covering. Most of the work, most of the topics we've covered them in the past 2 webinars. Welcome back. Yes, my name is Fosina Kaserera. I'm a CA and I'm your facilitator. I'm the one that has also facilitated the 2 webinars that we have had. I hope you have found the course rewarding because the first and the second assignments are the ones that we cover in critical topics. And then the assignment that we are going to have now is an easy assignment where we are just trying to give you a different kind of like scenario. It's a different kind of like a scenario where we say, okay, this is your firm. These are the business transactions that occurred in a particular month. So we start with the fees. These were the invoices that were raised for the fees, and then we continue. We also go into business transactions. We mentioned the business transactions like say, for instance, if you receive a bank statement, you would find in a particular bank statement, there are various transactions that go through that bank statement. And then when it comes to the trust account, it's also kind of like the same thing, where you receive various transactions that go through. So each day you would find a firm would record the transactions differently. So in this case, in our assignment 3, that is a similar approach that we have done. Make it different so that you can apply your mind. So this is more of like just a practical example where we want you to apply yourself, where you then are supposed to more of like look at the given scenario, and then you are able to distinguish transactions for a particular client, and you are able to distinguish transactions for a particular ledger, so that you group them together. So the idea is for you, like what we have said before when answering these questions, we always have one cash book because we are utilizing one business account, we are utilizing one trust account. So it means we are to have one trust cash book, one business cash book, which means the transactions, all of them, then they have to appear in that one business cash book, in that one trust cash book. And I hope the way that we have structured the question, you have found it easier. As you know, with a law firm or a legal practice, fees are sometimes received in advance. And when fees are received in advance for work that we have not done or where we haven't raised an invoice, that money is taken and then it is put in a trust account. So when the money is put in a trust account, then when an invoice is raised and the firm is to perform a trust transfer, that is when then the money moves to the business account. So that one we have explained it. So when you look at these transactions, then you should relate them. You should relate the trust account movement to the business account. And also the idea, the rules always stipulate that we are supposed to make sure that we record the transactions. So, which means that before we can make a transfer into the business account, then we have to raise invoices so that we recognize and the client is able to get the money. So that is the same thing that would be happening. So yes, welcome, and I hope you find that question practical, you found it applicable to the current scenario in firms. What we have also tried to do is to incorporate what is happening now. Like I said before, with firms are supposed to go onto the sweeping system. The sweeping system, it's a system where the bank itself helps the firm or the practice, let me say the practice, it helps the practice with balancing of interest and bank charges. So in this webinar, I saw a question. So basically this webinar, the way that we have designed it was, we just wanted to understand your questions, areas that you are lacking, so that we explain them further. But from the response that we have seen online, we have seen that most of the topics, I think you understand them. The way to answer, you understand it because you did not post as much questions that we anticipated. So in that case, then this webinar is going to be a very short webinar, a very sweet webinar. I'm not going to take a lot of time. I'm just going to answer to the questions for those that have posted, and I assume that you have understood the topics. We have confidence. If you are given a question, if you are given a scenario, you are able to then update the accounting records of the practice. You are able to come up with the trust ledger. You are able to come up with the trust cash books. You are able to come up with the investment cash books. You are able to come up with investment ledgers, so that when you present them to your auditors, you understand these things. The idea for bookkeeping, of course, bookkeeping remains to bookkeepers, but for you guys, you have to have an understanding of your transactions, how they are recorded, so that whenever you are asked to come and answer, then you have a background of what is happening. So thank you for those that have asked questions. I'm going to now go into the questions that they have asked, and then we help them with answering those questions. Once we are done with answering those questions, then our webinar will be completed. If ever you do have any queries, then you can post on the forum. I know I've been slow on the forum. I've not been feeling well. I've had an operation done in June, so I've been slow in answering, but I've been monitoring what has been asked and also just attended to that. And I see most of you should be busy because you are not posting any questions, or you have a very good sound background of our subject matter. So yes, thank you. I'll move on to slide number 2. So welcome. We have covered all the topics in webinar 1 and 2, and in this webinar 3, it was just more of like a question, kind of like a webinar, where then I need to understand if you are at par or you have other things that are giving you problems. And given that you have attempted assignment 1, assignment 2, test 1, and also you have attempted a lot of quizzes online, then I assume that you are now confident in answering questions. You are now confident whenever you are given an accounting scenario. Yes, thank you. Okay, so questions. This is what we asked. We asked you to post questions. So the 2 questions that we posted pertaining to our subject matter. Question number 1, which is on our left, is the bank charges and interest in the trust account, how to treat it, and the LPFF portion of it. Okay, so that is a crucial element of the trust account, because what will happen with the trust account is that the bank will always charge a fee for maintaining the trust account. So there is a monthly fee that they charge, that they've agreed with the LPFF. And this monthly fee actually applies even if there are no transactions. So like what I've said before, practices should ensure that they go to the banks and then they go on a sweeping system. So the sweeping system, what it does is that it then works electronically, technology on behalf of the attorney. So what it does is that it links the trust account with the business account. So where bank charges are higher than interest, what the sweeping system does is that it will ensure that then it transfers money from the business account into the trust account so that there is no deficit, so that the ATIN would not have to worry about the account being closed by the bank if it is not active, because the bank on a monthly basis will equalize the trust account and ensure that it is not in deficit. So say, for instance, you haven't started trading and then you put in 500 Rand to open the bank account as required by the bank, and then you go on the sweeping system. Then the bank charges, when they are being processed on a monthly basis by the bank, what will happen is that the bank itself then will equalize, and it does that also including the VAT. So what the LPFF, the fund, I'll call it the fund, what the fund has done, it has negotiated with the banks and it has informed the banks that the VAT charged on bank charges by the banks should be recouped by the firm or by the practice from the South African Revenue Services, SARS. So what then the bank does on a monthly basis is that when we check on your bank statements, especially if you can check with FNB, you will see there's a VAT recovery. So which means that on your bank charge, the amount that you have charged, you are charged, the bank will recover that amount from the business account, assuming that when you submit your VAT returns. So for those who are not VAT registered, it's a disadvantage because you can't recover that amount from you can't recover that amount from SARS. But for those practices that are VAT registered, then they are able to recover that amount in the business side of things from the South African Revenue Services. So on the trust side of things, that transfer, we bundle it up and put it in the LPFF account. So what I'm going to do is that I'm going to do an illustration in assignment 1, question 3. We had a question, assignment 1, question 3. As part of that question and the trust section of that, we had transactions where we had bank charges and then we had interest that was earned in the trust account. So this firm, we assume it is working and it has got money in the trust account and it is receiving interest. If a firm is not receiving interest, well, yes, the bank charges will always be debited and the bank then will equalize and recover. If a firm is not on the sweeping system, then it means then the practitioner should then deposit in money to cover those bank charges on a monthly basis or every 3 months to make sure that those charges are not going to interfere with the trust account and the trust account does not end up being in debit. Okay, so assignment 1, question 3, we had these 3 transactions which read 30 June 2022. There were bank charges which were debited of 92.50. So when the bank debits the trust account, they more of like debit it, including the VAT. So in the 92.50, they've already included VAT in the 92.50. And then what then they do is that, okay, which means if they debit 92.50, they've taken VAT from trust funds, which they are not supposed to take. So what then the bank does is that then they recover the money, the component of the VAT. In this case, it's 12 Rand and 6 cents. I will show you how we arrived at 12 Rand and 6 cents. That then they recover it from the business account. So when they recover it from the business account, then it is up to the practice to then claim it from SARS, because that money is supposed to come from SARS. It is not supposed to affect the Attendance Fidelity Fund, and it is also not supposed to inconvenience the bank because they want their fees. Okay, and then in this case, there was interest earned. Okay, so what I'll do is that I'll move and share my screen. Hopefully you'll be able to see. I'm going to share both, try to share both the Excel working as well as our question. Okay, so I'll click on the Excel and hopefully you can see my current screen. So what I have basically done is that I have taken, we answered this question, and as part of our lesson 1, what we have done, we've answered, as part of assignment 1, we have answered question 3, but we only ended up on the trust cash book. And on the trust cash book, I will put these two side by side like that, so that you are able to see the questions that we are asking. Okay, so as it is side by side, we start with the interest. So on 30 June, the trust account, there was 204 earned in the trust account. So which means the trust account is receiving some money from the bank because it had money throughout the month. So what is going to happen is that on our debit side of the cash book, which is also more of like our receipts, and then the credit side is our payments. So when we are doing a T kind of like account of a cash book, then we are supposed to then show that the debit side is for receipts and then the credit side is for payments, so that it becomes easier. When you look at transactions, you think in the terms of did the firm receive, did we receive money? So if we received money, whether it be interest, whether it be client's money, yeah, the trust account is received money. So what happens? Then we are supposed to put it on the receipt side. Then it makes your life easier in terms of thinking about the way that we post in terms of our accounting treatment. It makes life easier because then you know this is a receipt. I'm just going to put it on the receipt side, which is the left side. This one is a payment. I'm going to put it on the credit side, which is the right side. So I have not presented in a T format, but I guess you understand even this format that is there. So 30 January, we received interest of 204. So for our trust account, general trust account, the net interest that is earned in a particular month is payable over to the fund. So what the fund has done is that it then allows the firm to withhold, like to take the bank charges so that they are not burdened. The firm is not burdened by the bank charges that are levied. So if a firm manages to generate interest out of the funds that are held, then the firm deducts the bank charges, and what is left out of those bank charges is paid over to the fund. So how we are going to show that, we are just going to consolidate in a LPFF ledger. Where no interest is received, then the money has to come from the firm. So this is assessed more of like on a monthly basis. And even the banks, they do it on a monthly basis. So if you have a month that you've earned interest, they will just sweep on that month. In the following month, you have not earned enough to cover, the bank will not sweep. So it will not go back and say, oh, okay, the other month the fund has already received. Can the fund refund you? So the fund will not refund back the money to the firm. They do it on a monthly basis. They've said they're going to do it on a monthly basis, and every assessment is done on a monthly basis. So you can't, when you're doing your audit report, you are not then able to then say, okay, my bank charges are more and I've paid something to the fund and I need to recover it. The fund will not reimburse in that way. Okay, so for the interest, I'm going to record the transaction in the LPFF ledger. In this case, it's interest. So because the LPFF, the fund becomes our creditor, we received money on their behalf, which is the 204. Then we show it, we've received on their behalf. It's on the credit side to say it is our creditor. So this is debit and then this is credit to complete the transaction. And then we then record the bank charges. Remember, we pay the net amount. So the bank charges for that month, we are going to have a debit balance. Why a debit amount? To debit the account, it's because what we are then saying is that we are reducing our balance 204. So to the fund, we can't give them 204, we have to reduce. So in this case, our formula, we should show that it is our balance minus our debit, and then we'll add anything on the credit. So that's how we come up with the formula for our ledger. Our formula, it's our balance minus the debit. If ever we happen to have a credit, then we add it, then it gives us our balance. Okay, and then there happen to be VAT that we have recovered. So the bank has taken 92.5 and the fund is saying, no. The only amount that the firm can deduct, it's net of VAT. So what the bank then does is that it goes and recovers that money on behalf of the fund. And that amount, VAT on bank charges, then it's more of like recovered on behalf of the fund. The fund is more of like now the one which is going to receive. So at the end of the day, you would find the bank will pay over to the fund an amount of 123.56, which is our 204 minus our bank charges. So it should be net of VAT. So if it's net of VAT, it is like that. And then if we calculate it, then we come back to the amount that is payable. This is to confirm that our formula is correct. So it's our interest minus our bank charges, which are net of VAT. So 92.5 would mean it's including VAT. And for us to calculate VAT, the 12 rands 0.06, we say 92.5, which is our bank charges, multiplied by 15, because this is a wholesome amount. It's inclusive of bank charges. The bank has included it's inclusive of VAT. The bank wants its money inclusive of VAT because they want to take that VAT and pay it over to SARS as its obligation to SARS as a VAT vendor. So how we get to this amount is to say the wholesome amount multiplied by 15 divided by 115. And then we come up to our amount. I think the differences here, it's all because of rounding off, but which shouldn't be a problem. Yes. So say, for instance, we were then instructed to say the bank paid over the money to the fund on the 1st of February 2022. Then what you would then see would be a payment. So it would be more of like just trust bank and then payment to LPFF. So the payment then that we make is that of the 123.56. So this is how we account for the bank charges. And even when you are completing your refund form, you find they also ask to say how much was the VAT, and then they say in the VAT on the bank charges is supposed to be subtracted. So you'd find your auditors, they get to work out for you and then submit. So I hope you have understood the section. And when we are working out this ledger, one thing that you should note is that this only applies to the trust account. So what we should try to avoid is to create an LPFF ledger for the trust and the investment, and we combine everything together. If we combine everything together, then it's going to be very difficult for you to trace the transactions. The best would be for each and every transaction where you have a Section 86 investment, then that one should be treated separately so that you do not mix up. That is how we then treat our transactions. And then that one of the investment account, like previously discussed, it normally, if you're on the sweeping system, and now the banks are now on the sweeping system because they've got an arrangement with the LPFF, with the fund. So what they do is that from that investment account, they pay directly to the fund. And when they pay directly to the fund, then it makes it easier for the practice. Then they don't have to pay anymore from the trust account. But say, for instance, the bank does not do the payment, then before the firm can withdraw the funds from the investment account, because remember, if we invest in terms of Section 86(3) or 4, then the money is supposed to come back into the trust account. So before the firm can transfer the money, they can calculate the interest, the 5% that is due to the fund. And in that investment account, they can pay it over to the fund. Or say, for instance, then they bring back all the money into the trust account, then it would mean that the fund is then going to be paid. When the client is now being paid 95% of the amount, then the fund then gets paid. And then that, to make it easier, you can avoid creating an LPFF ledger for that particular transaction, but by posting that leg of the transaction under the client. So you are more of like accounting to the client to say, okay, we received 100 Rand in terms of interest, 95 rands, which is 95% is yours, and then 5% we've paid it to the fund in terms of the act, in terms of the new dispensation that was given by the fund. Okay, so I hope you have understood that part. So you can treat it according to the way that you are instructed, or the way that transactions appear on the bank statement. So the bank statement usually is the one that guides to say how are you going to treat the transactions. Okay, thank you. We move on to our second question. So we've got two questions. The other question says, kindly let me know what happens if the client deposited a property transfer deposit into the business account. Okay, so when you look at these transactions, all that you think about are the rules. You look at the rules, what happens? Remember our rules, they take us back. They say there shouldn't be any mixture of trust funds and business funds. So the moment you come across any trust funds, you have made a mistake. Mistakes are common and they are acceptable. Anyone can make a mistake. Say, for instance, you pass on your transaction over to, you pass on your banking details to the client without noticing that it is a business. It is a business account. So you have given them a business account rather than giving them a trust account. So upon realizing that error, when the money comes in, the first thing that you should do would be to transfer that money into the trust account. And that is it. You transfer the money into the trust account. And once the money, with the reference which indicates that you are paying over on behalf of your client, and once the money is in the trust account, then you apply all the relevant accounting principles that we have discussed in this topic. So it's as easy as that. You just transfer the money. It's an error, it's acceptable. You don't have to even notify the LPC to say, I have made an error, I have received money in the business account. But probably you can then notify your bookkeeper so that when they are recording the transaction, then they do not record the transaction as if it was part of the trust transactions. Sorry, it was part of the business transactions, or like as if a debtor was paying for an invoice. No, it shouldn't be part of income of the business because it is not part of the income. We have not raised an invoice for the money. It is for a transfer of a property on behalf of a client. So anything that is on behalf of a client, we pay it over to the fund. Okay, thank you. So the other thing that I then just noted was that I have just come up with notes on interest on Section 84 investment accounts. So like what I've explained to you, most banks now use the sweeping system. So you would find when you are recording the transactions, they've already occurred. Remember, us as accountants, as bookkeepers, we record, we are always recording historicals. So historicals, it means there are people who are working on the transactions, and then we record. If ever we note any mistakes and errors, then we inform those who are conducting the transactions to correct. And errors, like what I've said, they are acceptable. It's a matter of people correcting. That's why then the LPC say in their rules that our records should be updated on a monthly basis. So the good thing about a monthly basis, they used to say on a quarterly basis. So the challenge with the quarterly basis is that when we record on a quarterly basis, then you find if ever there are errors, then we'll pick them in 4 months. We'll pick them like now we can't remember what happened to the transactions. But if we do it on a monthly basis, then it means we notice mistakes, we notice errors, we do our bank reconciliations, and then we are able to rectify any mistakes. And if ever there are any accounts and debits, or if ever there are any bank charges which have caused the account to be in debit, then we are able to quickly correct without getting into trouble. And then we can always then explain past journals after correcting, and then we show our auditors to say, no, this was to correct this and that, this was to correct, which then enables us not to be in trouble with the LPC. Okay, so most banks are now on the sweeping system. If not on the sweeping system, if your account, your Section 86 account, you have gone to the bank, they've not put you on the sweeping system, then it means then that interest you can then just pay it. You pay it directly from the trust account, and then you pay it directly from the investment account. If you fail to pay it from the investment account, or you notice that your practitioner or the directors or whoever is handling the accounting who transfers has forgotten to pay the interest from the investment account, then the money has gone over to the trust account. Then from the trust account, then they can still pay to the LPFF. So with these accounts, the LPFF, you can always phone them. They will give you specific accounts where the money is paid. And then the interest that is payable should be 5% of the interest. And it's a simple calculation. If someone is earned 100 Rand in terms of interest in a Section 86 account, interest calculation is 5% of that 100. And when you take that 100, then you pay it over. The 95%, it's a simple calculation which then goes to the client, depending on whether you've agreed on an admin fee or not. Okay, so like what I have explained, a separate ledger should be opened for the LPFF to differentiate interest earned in the trust account and interest earned in a Section 86(4) investment account, then that would make your accounting easier. Okay, I think I am done with the 2 questions that we were given. If ever you still have questions, then you can always ask. And also, I noted there was a question. And the question was that, okay, it was about load shedding and deadlines. In view of the punishing load shedding schedule at present and the fact that the answers to any questions will only be posted on the day the test is to be completed, 8 July, please could you consider an extension of a week or 2 for the completion of the course? Okay, given that we have covered the topics, we have covered everything that is essential in the course. When I looked at this question, thank you so much for the contribution, but I felt like because we were just looking at questions from the learners, and as I see it, there isn't much of questions. So according to me, I didn't see any need for any extension because this webinar is small. It has got just 2 questions. And then the others, the second question was just like a simple question. And the one on bank charges, I know we have a question in our assignment. I hope you'll be able to benefit. And also what I have tried to do is that I went back to the questions on the forum. You can go on the forum, and then I have also illustrated, I've put some journals, and then what I can do is that I can also go and post that working that I have done. I'll go on the forum under the questions, copy out it's assignment 1, question 3, the part of the bank charges, and then I put it in, and then I put in the answer for that one. Then it will be beneficial for you. So thank you very much. If you have any further questions in terms of day-to-day practice, anything that involves a trust account, business account, VAT, correspondence accounts, our investments, our conveyancing, then you should let me know, then I'll be able to answer them. And probably it will be just for the benefit. I want to thank you much. Like I said, this is going to be a very short and sweet webinar where we are not going to throw in a lot of issues because we are done with the course and we are happy with the way that we have conducted the course. And one thing that I need to commend the Law Society of South Africa for is that they've introduced these webinars on your group, and I have seen on assignment 2, you have done extremely well compared to the other groups. The other groups were assignment 2. So these webinars, I think, will have to continue for the benefit of you guys, because at least we can illustrate how things are done, and then you are able to then go and then apply and answer the questions, because this is a practical subject where you can only apply by answering questions. So I wish you all the best in assignment 3, which is a very easy assignment, almost similar to assignment 1, only that this one we've made it a bit more complex in that we have lumped up all the transactions, as well as we now require ledgers. And in assignment 1, we only required cash books. So yes, I wish you all the best and thank you.